Alright guys, welcome to day 5 already of Anomaly sequence. Finally, we're getting a little bit more technical terms, showcasing you guys a little bit more chart work. I understand that it might be a little bit boring going through the whole discipline aspect, but at the same time I also don't want to keep that dopamine trigger high, oh great, Max is showing charts again. I want to make sure that that is minimized and that we're being a little bit more constructive with the way that we go about this, in a more rudimentary manner, where we are exactly building up those cornerstones bit by bit and making sure that you are learning everything, which will eventually become a whole and eventually be something that you can apply yourself, rather than just hoping that I feed you execution time frame stuff on a silver platter. So without further ado, let's kind of go into it. I'm going to minimize my camera just a tad, so you can actually see the words that I'm putting out here. Today we're going to be talking about the basics, right? We talked a little bit about liquidity. We talked about market dynamics in the first technical lesson on day 2. This is day 5. This is wrapping up our first week of lessons, our first week of stuff, and I want to make sure that today we talk about the two different types of markets, liquid market and an illiquid market, and from there I also want to introduce you guys to pretty much the way that the market breathes. There are only two ways that this market kind of rotates like a pendulum, right? It keeps rocking back and forth from one way of transacting to another, and then I want to introduce you guys to pretty much the core principles of the market and how they work. So in front of you, you see two different ways of identifying the market, right? We've got a liquid market and we've got the market in an illiquid state. At the end of the day, what I want you to best understand is the difference between these two, and that both of them are very, very necessary in order for there to actually be some sort of development in price. We need a liquid market to occur for us to pretty much get the price action, the arrays, and all that good stuff that we want from an illiquid market. So if you're not familiar already with my previous liquidity videos, we have a ranging market, transactable market, liquid market. What we call this is a collection phase, right? It's when price consolidates, collection, but what is happening here is that the market making capable participants are very content with transacting at these levels. You got to understand that this is where Forex gets to do what Forex has to do. That sounds a bit vague, but it entails that big financial institutions are able to transact at these levels, exchanging their euros or for dollars without there being a lot of fluctuation in the market price. This is nice because, there's only an X amount percentage of the people that have a speculative basis in the market. The others are commercial, right? Commercial positions that need to actually fulfill the action of Forex for their clients. Whether you're an investment bank, a central bank, any of those firms, they need to actually transact their transactions to fulfill the whole purpose behind foreign exchange, instead of just for a speculative basis, right? So that's when the collection phase is very, very crucial, because it allows for these moments to happen. It allows for there to be a transactable period. It allows for buy side to step in and transact with sell side, and vice versa. So understand that this is a key cornerstone, that without a liquid market, without there being transactability in the market being dense, we cannot have any of the other phases. We cannot have the other phase, and that is the expansion. With every collection, there is a displacement, right? With every consolidation, there's an expansion. The market moves in these two ways. Exactly with what we talked about in yesterday's video about the premises of the logic, the market will move from consolidation areas with displacements, will expand into other consolidation areas. So it's pretty much an never-ending balance between these two. That is another valid premise that you can add to your logic theory. So an expansion, a displacement pretty much entails that the market is moving either directions, right? We don't know whether it's moving upwards, we don't know whether it's going to move downwards. That is the thing that you want to avoid. You want to avoid trying to guess the direction of this, right? What you want to be doing is, when you have confirmations of this direction, to trade alongside that expansion, that displacement, right? And from there, you will go into the next two, right? But it's not that difficult to understand that we are not here to speculate which direction the market is going to go from a collection or consolidation phase. What we want to do is understand that the market moves in equilibrium between these two, right? And if it showcases an expansion, then the question mark is, where will price expand to? Can we partake to that? Most likely it will expand to another consolidation that was previously, in the history of the charts. And then from there, it will do another expansion, right? And this is where you get models, right? This is where you get stuff like buy models, sell models, where you get the expansion days, the classic scenarios where you realize that you're not necessarily speculating what's going to happen next. You're just partaking in the reaction, right? You are reacting to price. You're not trying to predict price. We're not trying to predict this movement. We are reacting to it. So in this case, if there's a confirmation upwards and we see price creates this displacement to the upside, our best bet is to partake in that, right? If it's just pure an expansion to the upside. So it's a yin and yang between these two. Collections, displacements. From every collection, you will find a displacement. And if you already know, right, and that I'll save that for later, but I'll give you a hint. These two become the final part, retracement or a reversal. Those are, quote unquote, if you've seen my liquidity videos, you already know what's coming. So collection phase, displacement phase, and these two are both fulfillments in price. So if you go a little bit deeper, and I don't want to force you in that rabbit hole just yet, but it's when you have either a liquidity seeking move or liquidity distributing move. A move that distributes current price action, or a move, volume, that distributes current volume, offsets volume, or a liquidity seeking move that seeks new volume to inject into the market, right? A reversal will be often enough an area where you can see new liquidities being injected into the market, because price reverses at this point and has a fresh new injection of liquidity with a lot of intent in that reversal. Whereas a retracement, you will see that price slows down, distributes in that sense, and find fulfillments in a previous leg, right? But if this gets a little bit too complicated, pause the video, go back, build it up one more time. The focus is these two. We want to focus between this, because in the next technical video, we'll go over graphical examples of this. And then from there, these two will become a little bit more evident, right? So let's first break down what it means when the market is illiquid. When the market is illiquid, it entails that it is difficult to transact because it is pushing to a specific area. You want to guess where? It's one of the premises from the previous video. Most likely to old highs and old lows. Why? Because that is where passive liquidity will lie. At old highs and old lows, you can see that price can get absorbed. There will be counterparties to absorb price. So if there's a buy-side inefficiency here, and it's lots of people buying up the market above previous highs in this expansion, there will be passive liquidity that can absorb the price. Starting to click, hopefully. Likewise, with retracements, those are usually after, right, we've run liquidity somewhere. So let's not go into too many details just yet. I'm using terminology here, and you might be scratching your head and you're writing everything down and you're like, okay, well, Max, you're going a little bit too fast. I haven't heard these terms just yet. That's okay. Write them down, note them down, highlight them, and realize, like, put a question mark and wait until we go over that. And then you can add that definition. We're not here to do a linear progression. Like I said, we're spiraling. We're going to be revisiting topics. I'm warming you up. I'm introducing a word. Then we'll break it down. We'll go over examples and vice versa. So bear with me. Overall, the most important thing that I want you to understand is that during these consolidations, we are building up pressure. In consolidations, right, if we're transacting at an area for long enough, it is not going to remain like relevant to transact at that level, right? What you'll notice during these areas, and I definitely recommend you to watch that liquidity video a little bit more. I go in way more detail, but for basic understanding what we're doing, if you and I were transacting at the same time, at the same level the whole time, eventually one of us is going to get sick and tired of it, and we'll kind of spread our bid and our asks, our offers and our bids further and further away from price at the extreme of that range, at the extreme, because we want price to transact from relatively cheap versus relatively expensive areas. And if we're building up an area that is considered relatively cheap or relatively expensive, then obviously we will want to contract these areas and then obviously break out, expand out of that. So have these patterns, memorize these patterns, what they are, become very familiar with these two, collections, consolidations, and expansion and displacements. It's the same concept. Choose a word that you like. At the end of the day, doesn't matter. It's really the same. Let's kind of go a little bit more into retracements and reversals, right? A retracement entails that we are getting an illiquid move. So an illiquid move to the fulfillment of that previous leg. So if we expanded higher, right, this expansion can be anything. So understand, see what I did here. That's exactly my point. An expansion can be one of two things. An expansion can be a reversal, or an expansion can be a retracement. A retracement into a previous leg, like this, or, you know, in this case, where we are reversing price and we are taking liquidity and we create a new trend, right? We are breaking it. So a retracement is just a pullback in that sense, right? Whereas a reversal is usually a bottom or a top, right? We are reversing on price. And often enough with both of these things, what we have here are key levels. These are levels where price will offset volume. So in this case, you usually have a key level here, and here we have a key level here, and that's totally okay as well. Either there or here, right? Either or, doesn't really matter. Here you can see in this case, we distribute volume, we retrace, we need to seek new liquidity, and we will push higher from there, right? Whereas here, it is that we're offsetting volume here, we've injected new liquidity, and we reverse this entire move here. Whereas here, it's like a continuation, right? One is a drop-based rally, and this is supply and demand terms. Bear with me. This is going to be sick. You're going to love this. Price moves, right, from collections. We can call these bases as well. These are obviously rallies, expansions. They move from one and another, right? An expansion is just the upwards movement. A collection is the flat movement. A retracement is a rally, a base, right? Potentially drop, but overall then another rally as well, right? In that case, this entire area entails that we're still going in one trend, whereas a reversal is a very easy one to spot. In this case, that's a drop base rally, right? Where here we are creating a base, we are transacting. This is consolidation. This is kind of a consolidation, but here overall, kind of what we're doing is continuing with trend. Maybe a lot of information, maybe you're like, holy crap, I just lost you there, Max. Don't worry, we will be going over this, we will be revisiting this, so it'll all be okay. But I hope that this makes sense, right? Now let's finalize this with just the definition of an illiquid market. An illiquid market is a market that leaves behind imbalances. Imbalances are what you might know as fair value gaps. Theoretically, those are flawed because fair value gaps entails and implies that there is fair value in that gap, which is not the case. What we want to be using is the concept of imbalances. Why? Because that basically entails that there's an imbalance in price, which just means that there has been an inefficiency, and that is the correct terminology. So note that with me. All these illiquid markets, there's one thing they have in common. All these expansions, and this is pretty much the umbrella of a retracement or a reversal, what they have in common is that they all have intent. Illiquid market has intent. There's intention for it to move somewhere. Whereas here, we are transactable. There's no intent for price to move somewhere. I'm going to keep it congested. I hope that you had enough dopamine from this video. And I will see you next week. And we're going to start this spiral all over again. Start off with a little checkup, and then build our way through 2 technical lessons, a little bit more discipline, logic, and so forth. But this is pretty much the continuation of our liquidity concepts. You can see that we built upon logic, our premises, and we are spiraling slowly higher and higher to make sure that it makes more sense. So, without further ado, I'll see you tomorrow.